السلام عليكم. لا تنسوا الإعجاب والاشتراك في القناة تشجيعا لنا لمزيد من العطاء والتألق.
The course for absolute beginners. The course, as always, will be orderly from the basic to the advanced level so that you will find it easier to follow. Without wasting any time, let's get started. Like any other market where you can go purchase stuff and sell them, a stock market is a place where stocks are bought and sold. A stock is actually an investment. When you purchase a company's stock, you are actually purchasing a small piece of that company, which is called as a share. The stock market is not one single physical market. It is a collection of a number of stock exchanges where the stocks can be traded. In India, for example, there are about 9 stock exchanges, but only a few are active and permanent. All these 9 stock exchanges forms the stock market in India. While the stock market trading primarily involves stocks, other financial securities like exchange traded funds or ETFs, derivatives, commodities, currencies, etc. are also traded in the stock market. We will learn about them in the upcoming videos. Now let us take a deep dive into one of the most basic economics on top of which the stock market is built upon. It is none other than the law of supply and demand. Supply and demand is one of the most basic and fundamental concepts of economics. Supply refers to the number of goods or the items that are available in a particular time. On the other hand, demand refers to how many people actually want those goods or items. So the law of supply and demand is a theory that seeks to explain the relationship between this availability and the desire for a product. In layman terms, low availability or low supply along with a higher demand for the item will boost the price of the item. And on the other hand, when there is a high availability but a lower demand for the item, its prices reduce. So if we graph this relationship between supply and demand of a product with a price, the graph will look something like this. I know the graph looks a bit too complicated, but let's understand the supply and demand concept through some relatable example and then extend these concepts with the stock market. Let's take a look at the first case, which is actually the price of oranges. Oranges are seasonal fruits and requires large amount of water during its growth. In this case, we will look at how a change in the supply of oranges changes the price while the demand of the oranges stay the same, which means that the demand curve doesn't change. In the particular year, the weather was perfect for oranges and water was abundant. Orange farmers have a bumper yield. This large yield will increase the supply of oranges. This can be visualized as a shift in the supply towards the right side in the graph. But because there is a large supply of oranges available on the market and the demand still remains the same, the farmers have to reduce the price of oranges in order to sell all of them. So, when the supply increases and the demand remaining the same, the prices will naturally decrease. This is the first point. Extending the same case, during the next year, there is a terrible drought. Therefore, the amount of oranges produced is reduced dramatically. This means that the supply has reduced, which is represented by a shift of the supply curve towards the left side in the graph. But because the demand of the oranges in the market stays the same, and the fact that there are fewer oranges to sell, the farmers will raise the price of the oranges. So the second point is that when supply decreases while keeping the demand constant, the prices will increase. Now let us move on to the case number 2, which is regarding a trending designer jeans in the market. So in this case, we will look at how a change in demand can change the prices of the designer jeans. So when a new style of designer jeans was introduced, it became the height of fashion and it got trending. Everyone wants to own a pair of these jeans. The shop owner ordered more and more of these jeans but still had a limited amount to sell. So this surge in the demand is graphed as a demand shift towards the right. With the demand so high, the designer could charge a very high price for the jeans. Here, the supply was limited, but the demand was very high that it caused the prices to rise. Now with the same case, a year later things changed. People grew tired of the designer jeans and they are no longer as popular as they were a year ago. The demand for the designer jeans fell. The supply is still the same. So the only way the designer could sell them is on a discount to clear the existing stock, which means that the prices will drop significantly. So the final point to be noted is that when the supply remaining the same and the demand decreases, the prices will eventually decrease. Now there is a third case where the supply meets the demand, which is the equilibrium state as shown in the graph. In the equilibrium state, the quantity demanded is equal to the quantity supplied, and as a result, the prices become stable. But this is not what we want to see in the stock market charts, because we want action. We want the prices to go up or down and not stay idle. Now, using what we have just learned and extending it to the stock market scenario, we can conclude a few things. First of all, at the most fundamental level, supply and demand in the market determine the pricing of stocks and securities. The simple reason is that if more people want to buy a stock than sell it, or simply the demand is greater than the supply, then the prices move up or increases. Conversely, if more people want to sell a stock than buy it, there would be a greater supply than demand and the prices would eventually fall. So understanding the concept of supply and demand is easy. What is difficult to comprehend is what makes the people favor a particular stock and dislike another stock. This comes down to figuring out what news is positive for a company and what news is negative. By news, what I mean are a few factors like the economic data, the interest rates, and the corporate results, which will directly influence the demand for the stocks. So if the economy is doing better than expectation, it creates more demand for the stock in the anticipation of better earnings in the future. Similarly, the market dynamics, the economic conditions, and the changes to economic policies tends to impact the overall supply of the stock. Now moving on to $1 million question. Why should you invest in the stock market in the first place? So let us understand investment from a broader perspective. Before answering this question, let us see what would happen if you choose not to invest your money and keep it idle. Let us assume that you work in an IT company and you earn Rs 40,000 per month, which means your first year income would be 4,80,000 rupees. And you spend the 20,000 towards your cost of living, which will include your housing, food, transport, shopping, medical expenses, etc. The remaining 20,000 is your monthly surplus. Let us make a few more simple assumptions to make the calculations easy. First of all, your employment promises you to give a 10% salary hike every year without fail. Secondly, the cost of living is likely to go up by 8% year on year, and it is going to stay at 8% over time. Let us say you are 25 years old and you plan to retire at 50 years and do not plan to shift your company at this point of time. This leaves you with 25 more years to earn, and you don't intend to work after you retire. Let us also consider that the expenses are fixed and you don't foresee any other expenses in the future. And finally, the balance cash of 20,000 rupees per month is retained and is saved without any interest. Let us also ignore the effect of personal income tax, if any, in this discussion. Now, going by these assumptions, here is how the cash balance will look like in 25 years. Now, if you were to analyze these numbers, you would soon realize a few things are quite interesting from the calculation. After 25 years of hard work, you have accumulated approximately 3.4 crore rupees. Since your expenses are fixed, this means your lifestyle has not changed over the years. So you probably may have suppressed all your desires and all your lifelong aspirations like a better home, a better car, vacations, etc. Now, even after you retire, the expenses will continue to grow at 8%. So the cash balance of 3.4 crore rupees is good enough to sail you through roughly about 15 years of post-retirement life. So from the 15th year onwards, you will be in a very tight spot with literally no savings to back you up. So what will you do after you run out of the money after 15 years? So how will you fund your life? Now that being said, is there a better way to ensure that you collect a larger sum at the end of the 25 years of your work? Now let us consider an alternate scenario where instead of keeping the cash idle, you choose to invest the cash in an investment option that grows at, let's say, 12% per annum. For example, in the first year, you retained the surplus of 2,40,000 rupees, which you invested at 12% per annum for 25 years, would yield around 36.5 lakh rupees at the end of the 25th year. Now here is how the cash balance will look like in 25 years. So with the simple decision to invest the surplus cash, your cash balance has increased significantly. The cash balance has grown to rupees 9.6 crores from the previous 3.3 crores. This is a staggering 3 times the regular amount. This translates to you being in a much better situation to deal with your post-retirement life. Now, having figured out the reason to invest, the next obvious question would be, where should I invest? And what are the returns that I should expect by investing? Now, there are different asset classes available for investment. A few of the popular ones are: number 1, the fixed income instruments. Number 2 are equities. Number 3 are the mutual funds. And number 4 are commodities. Now, talking about fixed income instruments, these are investable instruments with minimum risk to the capital, and the returns are paid as interest to the investor. And at the end of the maturity period, or at the end of the time frame for deposit, the capital is returned to the investor. Now, some of the fixed income instruments include the fixed deposits offered by banks, the bonds issued by Government of India, the bond issued by corporates, etc. Now, talking about the returns, the typical return from a fixed income instrument varies from anywhere between 5 to 9% on an yearly basis. Now, let's talk about investment in equities. As we have discussed, investment in equities involves buying shares of publicly listed companies from the stock market. So when an investor invests in equity, unlike a fixed income instrument, there is no protection for the capital. However, as a trade-off, the returns from equity investment can be very attractive. The Indian equities have generated returns close to 14 to 15% compound annual growth rate, or CAGR. So investing in some of the best and well-run Indian companies has yielded over 20% CAGR in the longer term. The third and one of the most popular asset classes is the mutual fund. So a mutual fund is a professionally managed investment scheme, usually run by an asset management company, which brings together a group of people and invest their money in stocks, bonds, and other securities. So it is actually dependent upon the stock performance to get good returns. Investments in mutual funds can yield anywhere between 8 to 12% return CAGR. Now, the fourth and final investment option that I would be talking about is the commodities. Investment in gold and silver are considered one of the most popular investments. So, investing in these metals have yielded a compounded annual growth rate of approximately 9% over the last 25 years. So clearly, equities tends to give you the best returns, especially when you have a multi-year investment perspective. That is not all. There are more advantages with equities as an investment option. Number 1, these days buying and selling of shares are really easy because they are completely digital. Second point is the power of compounding, which is considered as the 8th wonder of the world by Albert Einstein, and it works its magic for longer term investments. So with a higher rate of return and long-term investment perspective, you can make some serious money. Now, the third point is that you can win the race against inflation. During the end of December 2021, the inflation in India stood at around 5.59%, which is actually higher than the interest rate of most of the fixed income asset classes. But the inflation rate is not much significant in case of the returns that is provided by the equity option. And the final and the most attractive point are the flexible returns, because in equities, flexible returns are possible, which can actually make or break your account. Now, with that being said, risk and reward go hand in hand. Higher the risk, higher the return. Lower the risk, lower the return. So investments optimally should have a strong mix of all the asset classes. It is always smart to diversify your investment among different asset classes to optimize your risk and the potential rewards. For instance, a young professional may take a higher amount of risk given his age and years of investment available to him, while an older citizen can give more priority to low-risk investment option. The ratio in which one allocate investments across different asset classes depends upon the risk appetite of the investor. We will make a detailed video on asset allocation methods later. Well then, let's move on to the most asked question, or maybe the most frustrating question that people will ask you. Isn't stock market gambling, or isn't stock market purely based on luck? Now before answering this question, let us briefly look at what probability is. Probability refers to the likelihood of an event happening. Let's take an example of tossing a coin. There are two potential outcomes when flipping a coin, heads or tails. We don't know which way the coin will land on a given toss, but we do know for sure that it will either be a head or a tail. Now assuming the coin is unbiased, the probability is 50% or 1 by 2 for either head or tail to occur. This is because you know the result would be either head or tail and both are equally probable. Now another example would be a 6-faced die. Now most board games such as Monopoly, Stake and Ladders, etc. involves rolling a dice. While playing these games, we hope for a certain number to occur so that we can defeat our opponent. But usually, the number that appears isn't always in our favor. If the dice has been constructed in a perfectly symmetrical manner, a single dice roll has 6 possible outcomes. That is 1, 2, 3, 4, 5 or 6. So each of these 6 possible outcomes in a fair die has equal chances of appearance. So if I want a number 6 to occur, the probability of getting the number is 1 out of 6 outcomes, or 1 by 6, which leaves us with a 16.66% chance. This is much lower in comparison with the tossing of a coin. Here's where we should talk about the concept of sample space. Sample space is a collection of all possible outcomes of an event. Let us say, in this case, we get 2 rolls of the dice instead of 1. Now you roll the dice twice, you have a 30.5% chance that at least 1 6 will appear in comparison to the earlier 16.6%. This is because the total sample space is now bigger. That is, the total outcomes are 36 when you roll the dice twice. And the chances of getting at least a 6 are 11 times out of the total 36 outcomes. This will get you a 30.5% probability. Similar is the case with the flipping of a coin, where your chances of winning at least a head or a tail increases with the increase in sample size. That is, when you toss the coin more number of times, the chances of you getting a head or a tail also increases. Now when it comes to gambling in casinos, the odds are not in your favor. No matter what game you chose to play, the odds of the casino winning your money are greater than the odds of you winning the casino's money. This unfair advantage that the casino has over you is called as the casino edge or the house edge. Let us understand this with an example of a roulette wheel, which is one of the casino's favorite games. A roulette wheel is numbered from 1 to 36. So you might think the odds of winning a single number bet is 1 by 36. However, roulette wheels also have a 0 and a double 0. The roulette wheel has 18 black numbered slots and another 18 red numbered slots and 2 green slots, which makes a total of 38 slots and 38 numbers. So you can place your bet on a number, a color, or a combination of both. Let us take the case where we place a bet of 10,000 rupees on the black color. In this case, the sample space is 38. That is, 38 possible outcomes are possible because there are a total of 38 colored slots in the roulette wheel. Since there are 18 black slots, the probability of me winning 18 out of these 38 possible outcomes is roughly around 47.3%. And on the other hand, chance for the casino to win is the rest 20 by 38 or 52.7, which is about 5.4% higher than my potential winning chance. So this 5.4% advantage that the casino has over me is called as the casino edge. The reward for complex games in casinos will be even higher just to attract more people. The reward in the games with the least casino edge will be actually boring. So in this particular game, even if you stand a chance to win twice the amount, so you will get 20,000 for your 10,000 bet. On a longer run, the casino is always the winner. And above all, more the number of people who plays the game and the more the time they spend in the casino, the odds of casino making more money is always higher. This is why casinos usually give you complimentary drinks to make you feel more comfortable, and you don't see any clocks in the casinos, so that people are not concerned about the the time. Similar is the case with the lottery tickets. So winning a lottery is actually a dream for many hopeful people. As you may know that it is unlikely to win a lottery. But what does unlikely really mean? Well, let's say that 1 million people bought lottery tickets. Now you have 1 out of 1 million chance of winning, but so does everyone else. So you can slightly improve your chances of winning by purchasing more tickets. But what good is 10 out of 1 million? It's still the same. So let us take this approach in the stock market scenario. Generally speaking, the price has equal chances of going up or down. That is a 50% probability. But this is actually in case of someone who has zero knowledge about the stock market, who just randomly buys and sells stock. On the contrary, when it comes to someone with at least a fair understanding of the factors associated with the stock price changes or how the stock market structure works, the probability of success can increase to 60% through 90%. To prove this, let us say the price is on a downtrend structure. The downtrend is associated with a strong down move and a correction pullback to the upside. So we can draw a trend line above the swing highs. Now the price pulls back to the trend line once again, and the more experienced trader who has a better understanding about the price action and market structure would bet on the price moving towards the downside again. And the probability of price movement in his favor can be more than 50% because he has a better strategy as well as a statistical edge over the market. Now, if a trader keeps a reward to risk of 2:1 for each of his trades, that is, for every rupee of risk he is willing to take, he is looking to gain 200 rupees in return. Let's say he has an accuracy of only 50%, which means he is not an experienced trader. But let's say he took 100 trades, out of which there were 50 wins and 50 losses. His win reward percentage will be 50 times the 2%, which will be 100%. And his loss percentage would be 50 into -1%, that is 50%, where -1 is actually the drawdown or the loss incurred in each trade. Now in this scenario, the trader makes a profit of 50% in total. Even though his accuracy was not convincing, the risk management part let him become profitable. Of course, we will have to account for the taxes and other charges, but still he is in a profit. Now, if the trader, after improving his skills, has a win percentage of 60%, which means that he has a statistical edge of 20% over the market, which is actually a big number when compared to the 5.4% the casino had over its customers in the roulette game. Not to mention, if the trader has a high sample size, the profit margin will be even better. So take this example for instance. A trader with a 2:1 reward to risk percent took 10 trades, of which 4 were winning ones. The rest were losing trades. So clearly the trader is losing money from the initial impression, right? But if he works upon his skills and continuously improves and backtest his trading strategy, then he goes on to take another 90 trades. Now the sample size is bigger and equals to 100. And even if he manages to get only 50 trades right, he will still be profitable. Another important factor is your position sizing. Even if you do everything else right but messes up with your position sizing, you can clearly wipe out your account. So with the right strategy, keeping the best risk to reward and optimizing the position sizing and focusing on the higher sample sizes will definitely help you survive in the stock market for a longer time. With that being said, the stock market is not gambling. You can always improve your odds in the market by constantly improving yourself, keeping the optimal position sizing, and taking rewarding trades and keeping your losses under control. So next time when someone asks you the frustrating question, you know what to say. So that is it for the first episode, guys. I hope you have learned something new. If you have, please do like the video and subscribe to the channel and enable the bell icon so that you will receive the notifications when we post a video. I will see you guys